The Milken Institute Global Conference is the culmination of the important work our centers do throughout the year and helps inform our agenda going forward. Each of you participating represents extraordinary expertise, an ability to mobilize significant resources, and a sincere desire to be a force for good. And for that, we could not be more grateful. It is my honor to formally acknowledge and thank the group of people who make this event and all the great work we do possible, our supporters.
Good morning, good afternoon, good evening, everyone. Welcome to our panel, which is Credit Opportunities, Managing Shifting Tides. My name is Kevin Duignan. I am the Global Analytical Head for Fitch Ratings, which means that I'm responsible for all the rating groups here at Fitch. I'll be your moderator, but what you're really going to want to do is hear from the esteemed group of panelists that the Milken Institute has been able to assemble. So with us today are Michael Buchanan, who is the Deputy Chief Investment Officer for Western Asset, Mathieu Chabran, co-founder of Tikehau Capital, Ann Walsh, the Chief Investment Officer for Fixed Income at Guggenheim Partners, and Don Young, who is a co-founder and partner at CBAM Partners. Given the title of our panel, our focus will be on opportunities in the credit market, which for lots of reasons that our panelists will share with you are increasingly challenging to find. We'll try and cover a range of topics from Fed and ECB actions to CLOs and leveraged loans and private credit. I have a series of questions that I'll pose to our panelists to get the conversation started. And our hope is to leave some time at the end for audience questions as well, which you can enter via the click on your screens. So Michael, let me start with you. And let's start by taking a quick look back before we chat about current and future opportunities. We'll see if there are any lessons to be learned there. The credit markets clearly became chaotic starting about 8 months ago, towards the end of February. But with chaos often comes opportunity. Any examples of opportunities that you saw or took advantage of as the markets were trying to digest all of the breaking news?
Yeah, absolutely, Kevin, and thanks for the Milken Institute for having me on this panel. I'm excited to be here and appreciate the opportunity. As you said, chaos oftentimes in financial markets creates real opportunity. And I think before you, and I'm sure we all have great examples of opportunities we were able to take advantage of in mid to late March, early April. But you really have to ask yourself, what caused that turmoil? And actually what got us out? Because we've never really gone from a period where we had a functional, maybe not a bull market, but a very healthy market, to a bear market in less than 30 days. And then a few months later, not saying things were back to normal, but there was certainly healing going on. So to understand that, obviously, I mean, everyone knows the virus was really the cause of the dysfunction we had in March. And in many ways, the market reaction was very logical. We didn't know a lot about the virus in terms of how it was spread or the fatality rate, or just how contagious it was. Probably more importantly, we didn't really know about policy response. We weren't really sure what was going to happen with respect to monetary policy, although we had some inkling. Obviously, the Fed was very proactive and aggressive in lowering rates, but monetary policy as well as fiscal policy. So as we started to learn more toward the end of March, and the CARES Act, although that wasn't passed, and we were hearing more about the primary and secondary credit market facilities, things were coming together. We were learning more about the virus, how it could be treated, therapeutics, a hope for a vaccine. And I would say probably most importantly, we started to see, and I know all the panelists saw this, evidence that very high quality companies were being able to access the credit markets. Very, very important. And I'm talking about companies like AA Procter and Gamble, bringing a 30-year bond, albeit at very cheap levels, very wide spreads, 225 over. Intel, high single A at plus 310 over for a 30-year. Coca-Cola, 260 over. These are real high quality companies. Don't really see these issues come very often. And usually when they do, they come at very rich valuations. So to us, the fact that these companies were accessing the credit markets was very important. It was certainly what we viewed as being a real opportunity. And when we thought about credit, we saw a lot of opportunities, a lot of values, a lot of potential for total return. But at Western Asset, we're always looking for healthy, good, risk-adjusted returns. So we felt like investment-grade credit would be what we would call a first responder market. As things started to stabilize, heal, that's probably where you would see the trajectory of returns being the greatest. And it turned out we were fortunate in that regard. That's kind of what we saw. If you look at the second quarter, long investment grade credit returned over 11%, even outpacing high yield, where we would argue there was probably deeper value. So that's probably a pretty good example of one of the opportunities we saw, how we took advantage of it. And I guess maybe I'll just end by saying, and I know we've come a long way from where we were in March, but we certainly do see opportunities out there, not as obvious, not as blatant, but they're still out there.
Thanks, Michael. So Don, similar question for you. Michael said that they were able to see some early opportunities, but from your seat in the early days, was there any time to actually look at those opportunities, or was avoiding risk as big an issue instead of capitalizing on opportunities?
Yeah. Thanks, Kevin, and thank you also to the Milken Institute for having us on. I think this was a particularly challenging downturn because the logistics of it were new. In that, usually when there's a volatile period, you're spending most of your time on a trading floor, surrounded by your analysts, your traders, and you're trying to make smart decisions on the fly. But this time around, the entire company is scattered in apartments and homes across the country. And it created a need for you to implement new processes and implement new technologies so that you could try to be as efficient as possible in a period where there's a significant amount of volatility. So, we tried to create all of that on the fly in the first couple of weeks of March, while, as Michael was saying, we were trying to figure out what the government response was going to be. And clearly the government was picking winners and losers. And so while we're waiting for the government response, you're also trying to do triage on all of the companies that you have exposure to or that you're thinking of putting exposure on. And so while you're doing that triage, there's, our analysts had to do a very quick analysis of which companies had the liquidity to survive a prolonged downturn where they were going to have very little, if any, revenue. So, if you're looking at one of the big U.S. airlines, for instance, in the early stages of March, they were burning $50 million a day, which is, $18 billion a year. And then, they were talking about, okay, now they've got the cash burn rate down to $25 million a day, which is $9 billion a year. If they have $18 billion of cash, now they have 2 years of runway. And then you're trying to rank all of these companies. Okay, this company has runway to last 2 years with no revenue. This company has 6 months. So you're trying to reposition your portfolios to eliminate the risk while also taking advantage of those opportunities. And like Michael said, the opportunities were everywhere. I mean, you could buy Ford bonds at 10% yields that are now trading in the 130s. So you would have had a 40% total return on that. And in the secondary market, you were buying very high quality companies at significant discounts, and it was a target rich environment. But it was you could only take advantage of that if you were efficient and if you were good at putting processes in place in a remote environment to take advantage of it.
Thanks very much, Don. So let's bring things forward now to the current environment. The early opportunities have disappeared. The Fed and other central banks flooded the market with liquidity, which brought a level of stability, but presumably that's at a cost. So Anne, what are you seeing in the corporate market now? Are opportunities impossible to find from your seat?
Well, they're not impossible, but we refer to this timeline and this time as the great truffle hunt for yield, and so it's getting harder to find. Private markets still allow for some yield to be achieved. To Michael's point, we haven't seen a full retracement in yields in high yield relative to investment grade credit, and part of that is because the Fed put a floor under investment grade credit yields and really stabilized the markets when they stepped in earlier this year. And that's been a very strong message to the markets. In addition, they've had a tremendous crowding out factor impact. And that is that the more they buy or say they're going to buy, the less there is for other investors to participate. And given the fact that yields in the U.S. Are still trading at, on a percentile basis, trading at some reasonable value, while on a nominal basis, it doesn't sound very exciting. But at least on a percentile basis, there's non-U.S. investors who are coming to the U.S. Hedging costs are down, and as a result, they're willing to participate in the U.S. fixed income markets. So the areas where there's value, even away from corporate credit, are structured credit or other areas of the market, which frankly we can refer to as orphaned sectors, where the Fed's not really purchasing and has really no indication that they would purchase. So away from AAA rated CLOs or CMBS, there are still some opportunities in structured credit. But you really do have to know what you're doing. And of course, these are institutional only markets. And because of Solvency II from major institutions outside the US, particularly in Europe, structured credit is still pretty much an abandoned asset class, particularly some of the esoteric sectors. Aircraft finance has certainly not made its way all the way back in terms of yields. And selectively adds an opportunity for some value. But we still have to be concerned with regard to downgrade activity and potentially defaults. It takes a long time to go through cycles. To the earlier points, this has been a very, very quick cycle period, but that doesn't mean that we're all the way through it. We are not fully recovered in our economy, and there's still more risk out there. So one has to be very, very selective in attempting to find good yield that will last in the portfolio.
Thanks, Anne, and I love the idea of the great truffle hunt. I'm definitely going to reuse that. And you mentioned a number of other areas we're going to explore as well in terms of CLOs and high yield and private credit. Michael, let me come back to you on the corporate side and what you're seeing and how you're advising clients when they ask about corporate fundamentals and pricing versus valuations. Do you see things changing in the near term at all?
We do see things changing, and I guess it probably that general question you're asking about, I would call it the disparity between valuations and fundamentals. That's a question we get very frequently from our clients, from consultants, any discussions we're having. And it's true, if you just look at overall fundamental metrics in aggregate, they're certainly stressed, and that shouldn't surprise anyone. You look at the the Q2 GDP print, negative more than 30%. Granted, we've come back, but corporate fundamentals are clearly stressed, whether it's leverage, coverage, and again, I'm talking about in aggregate. But if you look at it a little more granular on a sector by sector basis, it's a little more interesting, and I think that's kind of how we start to address this question. You look at some of the sectors that are holding up very well, surprisingly, consumer non-cyclical, whether it's healthcare, communications like wireless, food and beverage, technology. A lot of sectors are actually doing quite well and what I would call enduring through this very challenging time. And then you have the stress sectors. Those are the obvious ones, the transportation, restaurants, under severe, significant stress. So when you put all that together, again, you have that mismatch of fundamentals versus valuations, as we all alluded to earlier, that are somewhat stretched, or at least nowhere near as cheap as what they used to be. So the question is, are we going to eventually grow into this stressed fundamental condition? And I think the answer is yes. And the reason I say that is, if you look at the companies in the industries that are stressed, what have they been doing? They have been accessing the capital markets largely through secured financing. And we're very fortunate in that regard as a market in the whole. A lot of capital has been put on the balance sheets for airlines, for cruise companies, for restaurants. They are keeping that cash there and hoping the combination of that cash, of that strong, healthy balance sheet, in addition to continuation of accommodation in policy, whether it's fiscal or monetary, ultimately that will get them to a point where the economy reopens. And that is our view. We think the virus is transitory. It's hard to say when a vaccine will be fully distributed. Maybe that's not for a while, but the good news is a lot of these stressed sectors, a lot of these stressed industries have balance sheets that can let them tread water, buy time, get to a point where the economy starts to reopen. And we do think there's a lot of latent demand as we start to reopen. You are going to see a pretty healthy surge in GDP and overall demand. So the answer to the question is, we recognize the disparity right now. Doesn't mean that you simply just walk away and say there's no opportunity. We do think that ultimately you'll get some fundamental repair, and that will justify where current valuations are.
Very good. Thanks, Michael. That's great color. Mathieu, let me turn to you. So Anne mentioned possible opportunities in the private markets, which is your area of focus. Have the private markets been able to take advantage of the lack of opportunity in some of the public markets, or are risks just further amplified on the private credit side?
Yeah, thanks, Kevin, and good morning, everyone. Thanks to the Milken for having us on the panel. And yes, I mean, Anne alluded to that. It's very interesting. You're giving me the opportunity to elaborate on the private markets, because it's obviously a growing part of the overall credit market. So what happened, early March was effectively in itself another deleveraging, right? There's been a lot of leverage put into the financial market, and whenever the catalyst came, the virus, it was about deleveraging the overall system, and we tested the limit of a structure of a market that was very different from what we experienced in 2008, 2009, and hence, this massive sell-off in a matter of days, like Michael, reminded us, it took a matter of days when it took months, last time around. But by the same token, so, all this leverage that had to be taken out of the market, it's because the central banks, the Fed, the ECB said, you know what, we're going to bring, even more leverage. So don't you worry, the market, came back. And the central banks acted as a magnet on any QCIP bearing securities that would be eligible to the program. The private markets obviously are not QC-bearing securities, and until now haven't been eligible to any central bank's purchase program or intention to do so, which, by the way, if you allow me, Kevin, that's interesting. I mean, the central banks, they didn't buy, or not that much. They said they could buy. So the signal they were bringing to the market was, calm down, keep and carry on. On the private market, obviously the drop was not as quick, because we know on the private market every quarter, what's happening, and how we should be reassessing the risk profile, the underwriting profile. But you are still being compensated just for the underlying credit risk you're taking. You're not introducing effectively what I would call the very visible end of the market in opposition to the invisible end of the market, which are those central banks. And so the private market, at least for the first phase of what we've been through, Q2 and now Q3, now that the market reopened, have been from an issuer standpoint, from a borrower standpoint, a great alternative to the public market for the one who were not eligible. I mean, Michael reminded, high-rated companies, investment-grade companies, effectively able to issue zillions into the market. But if you were, a non-eligible, a mid-market company, and yet needed to access a new source of financing, this is where the private market became extremely appealing. Remember that 6 months ago, or 9 months now, I should say, at the beginning of the year, people were questioning whether too much dry powder had been raised, and if there was some kind of a bubble in the private market, in the direct lending, in the private credit market. And then as a consequence of this situation, it became actually a very legit alternative source of capital. We've seen, as a matter of fact, some asset managers providing some billion-plus type of private financing, which was unheard of, and becoming once again an extremely legitimate alternative to the bank market, to the capital market. And I actually think that that could last for longer. People are prepared to give away the liquidity that effectively the private market are not offering, although we could come back to the secondary private debt market, which are developing today, in order to have stable, non-volatile, recurring source of income. And we see a growing part of appetite for this asset class. I mean, Anne reminded that, and I think that is creating a new chapter for the private credit market on the back of the situation, which will benefit even more so for the structural tailwinds that we were seeing from an investor standpoint. We're now seeing more and more borrowers, corporates, and not only into the LBO market, who are trying to take advantage of this situation.
Excellent, thank you, Mathieu. And I'm going to come back to you on the dry powder in the private equity market, because I think that's another interesting place to explore. And it sounds like some of Anne's elusive truffles might be hiding in the private market. So let's drill down a bit more into one of the highest profile and most challenging areas of the credit market, something that's been mentioned a couple of times, which is the high yield, leverage loan, and CLO markets. Don, I know you're particularly familiar with the CLO sector. Are you surprised at how well CLOs have held up so far, given their exposure to highly leveraged credits? Are there still opportunities in that space?
Well, first, I'd say I'm not surprised at how well CLOs performed. I mean, if you recall back in 2008 and 2009, during the Great Crisis, the CLOs performed very well through that crisis, and that was significantly worse than what we're going through right now. I mean, I think there were 120 billion of defaults back then, and there's only 40 this year. And CLOs are structured specifically to take advantage of these kinds of periods of volatility. So, as a manager, you're not hoping for volatility that involves significant defaults and a pandemic, but you're hoping that there will be price volatility that you can use to enhance the portfolio by reducing risk and adding yield to it. So you have 10-year locked up financing, which enables you to be the buyer when other people are selling, and that's kind of what was the opportunity set for us during this period of time. So yes, during the March to June period, we traded north of $4.5 billion of secondary loans in an attempt to reduce the risk in the funds and to take advantage of some of those opportunities. It was, as I said, it was largely a function of doing very deep dive analysis on the individual companies and figuring out which ones were going to thrive in this environment. And I think there have been many surprises in terms of companies that I think, the rating agencies and the investing community thought were going to do extremely poorly during the COVID environment, who have actually done surprisingly well. Anything involving, outdoor sports or recreational vehicles or boats or bicycles or, anything in all of those sectors is having a record year. And I think if you asked people in March, they would have predicted otherwise. So there have been numerous opportunities, I think, to take advantage of mispriced assets. And CLOs, like I said, are perfectly designed to take advantage of that. And you ask, are there still opportunities? I think very much so. As Ann mentioned, high yield has gotten back inside of 6%, which, is not a very high yield. Loans are back inside of 6%, but structured credit and CLOs in particular have not retraced all of that. So I do think there's a significant amount of opportunity. You can still get double-digit returns in, double B rated CLO mezz, or you can get CLO equity yielding in the teens with very clean portfolios, as long as you're doing it with the right investment manager. So we think there's still significant opportunity to be had, but a lot of it's going to depend on how people position themselves for what for the next era of this pandemic.
Thanks, Don. And Ann, over to you. Don mentioned that high yield and leveraged loan default rates have been lower, I guess, than most would have predicted 6 months ago. Do you see that as sort of temporary relief and delaying the inevitable, and the day of reckoning is coming for many of these more highly levered corporates?
Well, it's an interesting situation right now in credit. It's really a sort of a story of two types of borrowers and their availability or ability to access credit. Those that can come to the capital markets have been able to surprisingly efficiently, even when you think that their balance sheet wouldn't necessarily deserve or merit that access, have been able to do so. And to Michael's earlier point, pretty effectively and pretty cheaply. And here's the good news for those borrowers, and that is because rates have been so low, even though they haven't retraced all the way, they are below 6% to Don's point. And so as a result, in the overall high yield market, as a result, they've been able to access fairly cheap credit. Now, the question is, does this create an even bigger problem of the quote unquote zombie company? And the zombie company is one that's over-levered, over-borrowed, and isn't efficiently using its capital. And there is a real risk here that money is continuing to flow because of its availability to less worthy enterprises, just keeping them afloat for longer and longer periods of time until ultimately they simply default. Then there are those borrowers who are, say, for example, CCC borrowers, or unable to access the capital markets or even efficiently access the quality private markets. And they're trying to access bank capital and through the leveraged loan market, but bank capital is less and less available. And levered loans are actually, they're down in their issuance. So those enterprises have a higher risk of default. Right now, just to quote S&P in terms of the downgrade risk from investment grade to non-investment grade, we've only seen about 250 billion approximately that's been downgraded into the fallen angel category year to date. S&P predicts approximately 330 million more. So it's a fairly significant amount of downgrade activity into that fallen angel category. That doesn't include those that are being downgraded from single B to triple C. So there seems to be, even though there's access to capital, the risk is still there, and the risk is of ultimately default. Defaults are up 7%. Our expectation is that default rates will come to double-digit levels in the not too distant future, and this is really because of the uneven availability of capital to be accessed by different types of enterprises, and of course different sectors. For example, the energy sector is still struggling quite a bit. So on a fundamental basis, there is continuing risk for individual credits to ultimately default, and we are seeing that happening. But in that, back to my comment about the great truffle hunt for yield, you can pick through individual entities and find companies that are survivors and, dare I say, even thrivers as we go into and through this cycle. But you have to be very selective, because on an overall basis, if default rates are at 7% and the high yield index is yielding less than 6%, on the face of it, you're not earning enough to pay you for that risk at this particular time. So there's still more to evolve. Plus, I would suggest that because of the speed with which we've come through this cycle, but we're not all the way through it, there often are ripples, if you will, and continued downstream impacts that have yet to be felt. But it's being supported, the overall market for credit's being supported by two things. One, money supply is way up. The Fed has definitely done its job, and it's definitely propping up credit. Additionally, in terms of just the overall level of rates, we're essentially in negative rates, and that's very positive for credit. But I would suggest that, again, it's very selectively being found.
Well, I think one of the points that you mentioned, I think, is really critical, and we forget we're only 8 or 9 months into this new world. So even though it feels a lot longer in some cases, given how much has happened in such a short period, it is still new. So we haven't established what whatever the new normal is going to look like. But Mathieu, let me come back to you, because Anne mentioned, the fact that, high yield and leverage loans defaults are likely to increase. That, seems like it would be a great opportunity for the private equity firms who have been sitting on the dry powder that you mentioned to try and deploy that for bargains. But at the same time, they're also trying to manage their current investments, which might be underperforming. Is there opportunity for the PE firms to take advantage of these opportunities, or are they too busy dealing with the difficulties in the rest of their portfolio?
No, I think there are plenty of opportunities, and there's been a lot of dry powder raised, as we said, on the private credit, on the private equity, which may have led to certain excesses. But on the back of this situation, and you're absolutely right, Kevin, to remind us that it's been only 8 months, and we haven't seen much. I mean, barely a quarter of reporting, much more to come. Some lockdowns, some curfews, everywhere in the world. We know that the situation is not stabilized, and we may not have seen what new normal reporting season looks like. This dry powder that has been raised by private equity investors, or that sits with a private credit fund, is a great news, because I think that as Anne mentioned, the public market are open, but it's one size fits all. If you're a double A rated credit or a double B rated credit, you've got some benchmark, and we will price off where the public market is quoted. The private market is very bespoke. It is very bespoke in any way. You can have a new stakeholder coming into a company, and granted, maybe we're talking more about the sub-investment grade, but we've started seeing that. Look at how many pref equities have been structured and invested in some publicly traded companies with publicly quoted bonds as a way to recapitalize a company that might have some trouble on the side, but maybe a bit of stretch on the balance sheet side. And this very bespoke, tailor-made approach, I think, is going to be a really differentiating in the coming months and quarters to effectively have the right solution for a potentially temporarily struggling company borrowers. And I think that's once again where the private market will be a great complement to what the public market can offer in this renewed liquidity phase that is being driven by the central bank. So equity, quasi-equity, preferred equity, subordinated debt, mezzanine, call it however you want, but this is where we see a lot of opportunity right now because credit and financing was wide open. It has created some stretched on the back of these past few months on the leverage, on the equity base, and I think that the allocation of capital is becoming critical from a manager standpoint in the of the resources that an investor is giving us. And here again, by going bespoke, I think that will help converge not only the needs of any given borrowers and what investors are looking for, once again in trying to avoid this volatility that is hurting many, but still looking for this yield truffle hunting, as Anne said. You're creating your own truffle here.
And I would imagine that's particularly comfort to you in given your French heritage. Before I have another question that I want to follow back with Michael on the Fed and ECB possible changes in terms of average inflation. But before I do that, I just want to check now that I can see all of our panelists just to see if anybody else wanted to comment on anything that we have touched on previously. Okay, sounds like everybody was cited enough. So Michael, has the Fed's and possibly the ECB's change to the concept of average inflation, has that significantly changed your credit strategy? And afterwards, I'd be happy to hear from you as well.
I think it's helped for sure. It's basically taken out the left tail, and it's not just the idea of targeting inflation and even a willingness to let inflation run hot. I also think it's just policy in general is extremely accommodative, and that's not just the Fed. It's globally pretty much all central banks, whether it's very low rates, whether it's QE, other programs I mentioned earlier about the primary and secondary credit market facilities. It's really important to note that I think the Fed has been very creative with how they've implemented that, and just the amount of capital that they've been willing to deploy, and they have not come anywhere close to deploying the amount that they have signaled they ultimately could. It's a little like the Draghi moment when he said whatever it takes. The Fed really wanted to convince the credit markets that it is there to restore and establish orderly liquidity and access to funding and capital markets. So I think the Fed has been very proactive in signaling to credit investors that to some extent they've taken out, like I said, that left tail. And if things really do get bad, if we see, for whatever reason, maybe it's a second or third wave, you see a significant pullback and a widening in credit, there's no question that I think policy would be there and the Fed would be there to do what they can to stabilize markets. I think most importantly, you saw this again with how they were innovative with their credit market facility, getting around that certification process that proved to be very troubling and creating their own index, the inclusion of ETFs, the inclusion of fallen angels. It really shows that the Fed gets it this time. So I think that's, from my standpoint, that's probably the bigger takeaway. It's not just the inflation targeting, it's policy in general. And I think that is supportive for credit and should provide a reasonable tailwind.
Okay. Thanks, Michael. And similar question to you. Did the Fed's sort of change in policy or indication of change in policy, that shift your strategy in particular, or was it sort of a confirmation of what you expected before?
Well, maybe more broadly, you should think about what the Fed's done. It might be useful to recall what the Fed's mission is, and I hate to be critical, but their mission is stable prices and stable employment. And a 2% inflation rate isn't necessarily, in our view, a terribly egregious inflation rate. I think it's going to be very challenging for them to manufacture that level of inflation because while they've certainly kept rates low and have signaled that they're going to keep rates at the zero level essentially through till 2023, they've also opened the floodgates to have borrowers lever up at these very low rates. And debt is not inflationary, debt is deflationary. When does it become inflationary? For all the monetarists out there, ultimately is when it moves into productive capacity and inflation is created through that usage. Just to have all this money supply floating around and this accommodation has pushed up the value and price of financial assets. I would argue that they supported the markets and created liquidity in March and April, and I think at a necessary time because the markets were definitely going into and were experiencing quite a level of seizure. And Ford was mentioned, the price of Ford by Don, and you've gone from a normal rate at the time pre the coronavirus epidemic of normal high yield levels or fallen angel levels that compensated for risk to 10%, and then back down to wherever they are now, 2% depending on where you are in the maturity schedule. I think that's telling us that the price function that would normally be going on in markets has been supplanted by the Fed, and I'm not entirely sure that that's been a positive outcome. I think they have, replaced market functions with Fed functions. And investors, particularly long-term investors, savers, are challenged. It's been a good thing for buyers of credit, but I am concerned that in the longer run, it's going to be more problematic. And again, price discovery is more of a challenge as to what the real risk, what's the real return for a given level of risk. So I'm not necessarily believing that we're going to see inflation anytime soon, but they would be hard pressed to reverse course. And as I already mentioned, we're in a negative yield environment, and that, generally speaking, is positive for credit. And I would say that their activity has definitely been positive for financial assets at this time.
Thanks again, Ann. So I think now might be a good time, unless anybody else has any other comments, to take a few questions from the audience, which are coming in fast fire on my phone here. So Don, I'm going to point this first one to you. Ann mentioned zombie companies, and the question is, what is your view on zombie companies being kept alive to avoid bankruptcy? Are they being subsidized just to keep unemployment from going above 12%?
I think in an election year, you always have to be suspicious about companies that have large numbers of employees being kept alive for union votes, et cetera. And the obvious one here is the airlines, right? As I mentioned earlier, they're burning a lot of money, and the government keeps pushing billions and billions of dollars into their pocket to keep those jobs. And it remains to be seen whether that'll end up being the right decision. But I do think there are a lot of zombie companies other than the airlines that are not being supported by the government, but they are being kept alive by their sponsors and or the ownership. And in some cases, I think that'll prove to be a very good decision. If the business is a fundamentally sound business that is just dealing with a liquidity crisis because of a short-term disruption to their business model, then yeah, it's absolutely the right move to extend it to further liquidity and keep it alive. But I think there are other companies where they're being kept on life support, but the eventual outcome isn't a very positive one. And I think Ann mentioned the energy sector. Obviously retail. There have been a number of not just bankruptcies but liquidations. And I think you're going to continue to see that in some sectors where the business model has been put into permanent doubt. But I think there are a lot of other sectors that have really outperformed. And I think what happened is COVID definitely accelerated what were already some pretty evident trends going from, old economy to new economy. The sector that performed extremely well through this was the software sector because of their subscription model. In many cases, their revenue and EBITDA was up year to date, versus a lot of other sectors that were obviously disrupted because they don't have a subscription model where they get paid, regardless of how their customer's doing. So I think the zombie credits that are out there is going to be a very wide range of outcomes, but the fundamental decision point is the business a long-term viable business, and is COVID just exposing weaknesses in it, or is it in secular decline and it's just not coming back?
Thanks, Don. There are a couple questions just related to the U.S. consumer, which is an area that we haven't really talked about. So I'll sort of generalize the question. Curious whether anybody will volunteer to take it, but just what the outlook is for consumer credit quality. We've had the U.S. banks, some of the major ones, report this week and reduce the increases in their loan loss reserves particularly as it relates to consumer assets. Do you feel that the U.S. consumer will remain as resilient as they appear to be at this point in time? Any volunteers for that one?
Sure, I'll jump in.
Thanks, Ed.
The consumer confidence was waning, believe it or not, in 2019, and led us to be concerned about a slowdown in 2020. Obviously, we didn't predict coronavirus being a pandemic catalyst for market disruption and a recession. The consumer, I think, is a couple of elements. One, the household sector is really in pretty good shape for the most part, notwithstanding coronavirus. There's been a tremendous amount of fiscal stimulus and what we might refer to as transfer payments. That's not really so much stimulus, because stimulus sort of implies that it would be on top of actually a well-operating economy. And this is more of a transfer payment function. It's actually brought quite a bit of money into the pockets of consumers. So generally speaking, the household sector was okay coming into this cycle. We were concerned about corporate credit risk and over-levered corporate and sovereign balance sheets. The household sector really changed post the global financial crisis and was much more stable and prepared for this eventuality. Maybe not as bad as we've seen it, obviously, but a slowdown generally. And I think, to Don's point, the coronavirus epidemic has certainly accelerated trends, whether they be in the corporate sector or in the household sector. Buying trends, buying online, consumer appetites have been changing. We've seen quite a bit of transition from cities to suburbs and exurbs going on as well. So the consumer is undergoing change, but I think generally speaking will be fairly resilient. we'll have a good sense of it as we come into the holidays. Interestingly enough, historically, holiday shopping activity has been more closely tied to stock market levels, which appear to be quite buoyant at this point in time. And so that leads me to believe that the consumer will probably be pretty positive in terms of overall tenor. Now, obviously, there's always an exception in terms of the ability to make payments. There's a certain segment at this kind of unemployment level where you're upper single digits that we have to deal with, and there is going to be a strong concern about those individuals being able to make their payments. And a lot is still riding on fiscal stimulus to come out of Washington at this point. But generally speaking, we've seen a tremendous recovery in consumer sentiment. It's kind of leveling off now, but generally, I'm a little bit more optimistic about the consumer and the household sector in terms of risk relative to, say, the corporate sector.
Thanks very much, Ann. So I'm gonna pivot with the next question because I don't have a good segue. It's on the private market side, and the question is, do you see significant opportunities in emerging markets, particularly on the private side? So Mathieu, I haven't asked you about your areas of coverage, but are you seeing things on the emerging market side being potentially opportunities there?
Well, we're not actually focusing on emerging market because the markets we're operating in, be in Western Europe, here in the US, already are offering enough opportunities as we've discussed. So I'm probably less qualified to comment on that. But if you allow me, Kevin, I just wanted to pick up on one thing that Anne mentioned about the price discovery, and I think it comes back to the private market as well. I think for the past few months, if my colleagues, panelists will allow me to say that, there's been this kind of game where it was all about front running the central banks. As much, as long as you were, a long an asset class that central bank could buy, you were doing well. And my concern in that environment is that when effectively money has no value anymore, then the investment selection, the asset selection has no merit. And I fully agree with what Anne said. I mean, we should, leave the market, make this price discovery. Effectively, coming back to the basics of this market, of the fixed income, of the credit, is to be able to come up with what is the risk credit premium you should apply. And that's one thing that worries me a bit, and that hopefully, should normalize over time.
Excellent. Thank you, Mathieu. Let me take one more audience question here, and then we can just wrap up with a final quick question for all of you that I have. And Michael, you alluded to this a bit in your comments before, and the question is, will we ever see a distressed cycle again, given the Fed and other central banks have moved to whatever it takes? So you alluded to before that if there is a second or third wave, you feel that the Fed and others are likely to jump in. So not that anybody is ever going to say there's never going to be a distress cycle again, but do you think this greatly reduces the likelihood that we'll see a significantly distressed market in the next couple of years, let's say?
It's difficult to say in the next couple of years because I do think that we're in such a fragile state right now that it absolutely necessitates central bank engagement, central bank involvement, fiscal involvement, and that very well. Although defaults could go higher, I don't see defaults getting out of control because of that. But does that mean that the idea of a distress cycle is completely off the table going forward? I definitely would say no. What you need to plant the seeds for a distress cycle is you need excesses. And that we all know that markets ultimately move in that direction. Good, healthy markets that generate good returns ultimately lead to companies making poor choices, and that ultimately leads to, or at least makes them vulnerable when you get a catalyst in an economic downturn. And I don't think that's dead. But you got to remember, we've gone through, not only coronavirus, but if you just look back over the last 10 to 15 years, starting with the global financial crisis, we continue to go through these periods of real stress, and each one is a vibrant reminder of just credit risk and the need, if you're a corporation, to have control of your balance sheet, to make sure you have ample access to financing, be more conservative. And so I think a lot of those attributes are still with corporations right now. I think once we kind of move past this, you will start to see some more dangerous behavior. But I think that's going to be years in the future. And I guess that's how I would answer that question.
Okay, thanks very much. So I guess there is something to be said for what doesn't kill you makes you stronger. So there's survivors from this, like the banks in the previous financial crisis. They are dealing with this crisis far better because of the lessons that they learned. So another potential positive takeaway from all this. So my last question, and I'll just kind of go around the horn on this one, trying to end things on a positive note. Although I do really feel like there were a lot of positive opportunities that were mentioned by all of you, and that is, can you imagine, or can you describe, hopefully realistically, where all of this doesn't end badly, or conversely, how it ends better than some are fearing? So, Don, do you mind starting out on that one? Do you have a potential vision there?
Sure. I guess that scenario is the election goes smoothly, power is transitioned smoothly, the Fed remains supportive, vaccine comes into play, COVID goes away, we somehow transition away from LIBOR seamlessly, and the Dodgers win the World Series. What could go wrong?
Right. I like it. Other than that, everything should be fine. Mathieu, how do you see things potentially ending reasonably well?
I think capital flows will be more selective, more discriminating, and that will be probably the key to solving the situation. And that comes back to the distress cycle you were mentioning earlier. I really think, and we started seeing that, capital market to be much more discriminating than they've been in choosing, the winners over these cycles, and not, maintaining the zombies company, we've been discussing. So if there is one positive, I would take of that is after 10 years or 12 years of very, very accommodating policy and money flowing, capital will get back being more selective, and that's a great news.
Okay, very good. I think we are going to win a prize for the word election coming as late as possible in a panel. So I had it at 58 minutes past. So I think we did a great job there of not stepping into that rabbit hole. But Anne, what's your thought on how things could end better than we fear?
Well, so as a fixed income manager, I'm usually very negative and risk averse. So I don't tend to look at the optimistic possibilities as much. But being here at Milken, and certainly with their sponsorship of Faster Cures and usual optimism, I would have to say that I never really felt that we had to have a vaccine in order for the economy and the consumer to feel comfortable. But I've always felt we had to have accepted treatments and therapeutics and a protocol that is accepted for keeping people well, healthy, out of hospitals, and certainly off of intervention treatments such as ventilators. That confidence that will come from that, and I think that's probably sooner rather than later, will be a big plus. And more than anything, will probably turn the cycle. And in the meantime, policymakers, particularly the Fed, are certainly doing all that they possibly can to keep markets stable. And I think, again, that's being expressed by the stock market more than even fixed income markets. So I think that that a therapeutic is going to be a game changer for us, and accepted protocols.
Thanks, Ann, and you definitely echo my feelings of it's difficult as a credit person. It's just not our nature to be optimistic. It's just degrees of pessimism. But Michael, let me give you the final word on that. How do you see things, or could you see things ending relatively smoothly? Let's call it.
Yeah, and I agree with Ann. And I'm a glass half full kind of guy. So I look at markets, and although you prepare for the worst, you also try to envision what could happen to generate, above average returns. And when I look right now, I would say that the odds of this ending reasonably well versus ending in a horrible fashion they're more favored to ending reasonably well for the reasons that Ann highlighted. One, I think policy will continue to be strong enough to buy time for those areas of the economy that are stressed. Secondly, I think corporations have learned to be very, very conservative. They're acting with a very conservative mindset, refinancing a lot of near-term debt, keeping cash on the balance sheet. I do think ultimately a vaccine comes into play, and that certainly will be a game changer for the economy. But even to Ann's point, the idea of learning to live with the virus is going to be very important. And I do think there's a lot of latent demand in the economy. So I think we'll eventually get there. And I think that's a realistic outcome. And so again, that's kind of how I would answer the question. I think there's a higher likelihood we end that way than the opposite.
Okay. Well, thank you very much, and thank you all to our outstanding panelists here. I know your insights are going to be really valuable to the Milken audience, and thank you to the Milken Institute for having us join today. And we wish everyone success in your truffle hunting and a Dodgers comeback. And we hope everyone stays well. Thank you very much.
Thank you.
Thanks.